Hi there, you're watching the video about the new lease standard IFRS 16 leases. I am Sylvia of IFRSbox.com and I help people understand and simplify IFRS. I have created the IFRS Kit, a complex IFRS course for you, plus lots of free IFRS materials, so you're welcome to check them out at IFRSbox.com. The new standard IFRS 16 will be applicable for all periods starting on or after 1st January 2019, so there is still some time left, and it means that IAS 17 leases will no longer apply. You can apply IFRS 16 earlier than that, but only with the new revenue standard IFRS 15 that is applicable from 1st January 2018. Well, these two standards are very closely related, and if your company is affected by IFRS 15 a lot, then you should probably consider early application of IFRS 16 too, in order to make restatement just once. The objective of IFRS 16 is to specify the principles for recognition, measurement, presentation, and disclosure of leases. And before we start explaining them, let me show you a few scope exceptions. So the IFRS 16 does not apply to various types of arrangements as shown here. For these types of arrangements, IFRS 16 cannot be applied, but there are two optional exemptions, so you can choose whether you apply these exemptions or not, and they relate to these two types of leases. Leases with a lease term of 12 months or less with no purchase option. This election is valid for all class of underlying asset, for example, for all motor vehicles leased below 1 year. In other words, you can't apply IFRS 16 for one vehicle and not apply it for another vehicle. And the second optional exemption is leases where the underlying asset has a low value when new, such as personal computers, and this is done on one-by-one basis, so not for the whole class. Well, I think it's good to have these exemptions because that will make accountants' life easier. You don't have to worry about some right to use the asset. You will account for the lease payment in profit or loss on a straight line basis or some other basis. Now, at the inception of each contract, an entity shall assess whether the contract contains lease or not. A contract contains a lease if it conveys the right to control the use of an identified asset for a specified period of time in exchange for consideration. And then the standard clarifies how to determine the lease term, how to separate non-lease components and other issues. But let's focus on the accounting for leases, and we'll start with accounting by lessees. The big change in IFRS 16 in comparison with older IAS 17 is that lessees do not classify the leases into finance and operating anymore. No classification. Lessees need to account for all leases in the same way, well, except for two optional exemptions that I just mentioned a minute ago. At the commencement of the lease, the lessee recognizes both the right of use asset and a lease liability. So here you can see that even when the lease is operating, according to previous definitions, lessee always recognizes some asset, and that's the huge change because before lessee recognized all payments under operating leases straight in profit or loss. The right of use asset shall be equal to the lease liability, and we'll show how to measure it in a minute. And then you should add lease payments made before or on the commencement date, less lease incentives received, if any initial direct costs incurred by the lessee, any estimate of costs for dismantling the asset and restoring the site if applicable, and if there is such an obligation. The lease liability are in fact all the payments not paid at the commencement date, discounted to a present value using the interest rate implicit in the lease, or incremental borrowing rate if not possible. What comes to the payment not paid at the commencement date? Well, fixed payments, variable payments like depending on some index or rate, amounts expected to be payable under residual value guarantees, the exercise price of purchase option if lessee will exercise it, and payments for penalties for terminating the lease if lessee assumes terminating the lease early. Subsequently, after the commencement of the lease, lessee needs to take care about right of use asset, and here the most common journal entry is to debit depreciation expense in profit or loss and credit right of use asset accumulated depreciation account. Well, this is the application of a cost model under IAS 16. But you can also apply fair value model under IAS 40 or evaluation model under IAS 16 depending on what you apply for your PPE and investment property and what your right of use asset is. Don't forget about impairment testing under IAS 36. With regard to lease liability, a lessee needs to account for interest on the lease liability using the constant periodic interest rate. So you debit profit or loss interest and credit lease liability, plus lessee needs to reduce the lease liability by the payments made. So the entry is to debit the lease liability and credit cash or bank account. Of course, lessee needs to adjust lease liability for some modification of contract if applicable. Now let's take a look at accounting for leases by lessors. Here, nothing much really changed comparing the previous standard. It means you need to classify the lease first and then account for it based on the classification. So the principal question is, are substantially all rewards and risks of ownership of the leased asset transferred to the lessee or not? If yes, then the lease is a finance lease, and if not, then the lease is an operating lease. You should answer this question right at the inception of the lease. Luckily, IFRS 16 states about 5 basic situations that normally lead to the lease being classified as finance. If only one of those situations happens, then the lease is finance. So what are they? The lease transfers ownership of the asset to the lessee by the end of the lease term. The lessee has an option to purchase the asset at a price that is expected to be sufficiently lower than fair value at that time. And at the inception of the lease, it's almost sure that the option will be exercised. The lease term is for the major part of the economic life of the asset, even if title is not transferred. Number 4, at the inception of the lease, the present value of the lease payments amounts to at least substantially all of the fair value of the leased asset. And number 5, leased assets are of such a specialized nature that only the lessee can use them without major modifications. How should lessor account for a finance lease? Well, the same way as under IAS 17, so nothing very new here, but let me recap. At the commencement of the lease, lessor is a finance provider and therefore he recognizes a lease receivable, and that's the debit side of the entry. The lease receivable is in fact net investment in the lease. And net investment in the lease is a total of fixed payments, variable payments, amounts expected to be payable under residual value guarantees, the exercise price of purchase option if lessee will exercise it, and payments for penalties for terminating the lease if lessee assumes terminating the lease early. So exactly the same items as at the lessee's side. All these items are in fact payments not paid at the commencement date, and they should be discounted, and lessor should add the initial direct cost to the investment in the lease, while the credit entry would then be an underlying asset. What about subsequent measurement? We have a lease receivable to take care about. We have to split the lease payments between reduction of finance lease receivable and finance income, and again, constant periodic rate of return shall be maintained. Now let's take a look to operating lease, which is much easier. Lease payments received from the lessee are recognized as revenue in the profit or loss, basically on a straight line basis or on some other systematic basis. And let me remind you that lessor keeps the asset in its own financial statements and depreciates it. So yes, under the new IFRS 16, it can easily happen that both lessor and lessee will recognize some asset in their own financial statements. Now let's take a look to sale and leaseback transactions. There's a transaction in which the seller sells the asset and he leases the same asset back. The asset, in fact, does not move, not necessarily. In this case, seller becomes the lessee as he takes the asset back under lease, and the other party is the lessor. The accounting treatment of sale and leaseback strongly depends on whether the transfer of asset is a sale under IFRS 15 or not. If the transfer of an asset is a sale under IFRS 15, so it means that control of asset was transferred, then the seller or lessee recognizes a right of use asset at the proportion of the previous carrying amount of that asset relating to the right of use retained by the seller. Seller also recognizes only gain or loss related to the right transferred to the buyer. Then the buyer or lessor recognizes a purchase of an asset under other applicable standards and accounts for the lease under IFRS 16. If the transfer of the asset is not a sale, then the seller or lessee continues to recognize an asset and the accepted payment is accounted for as a financial liability under IFRS 9, so it's a sort of financing arrangement. The buyer or lessor recognizes a financial asset under IFRS 9. So this was a short summary of IFRS 16, and this standard contains a lot of more detailed rules and specifications. So if you'd like to learn more, please visit the website ifrsbox.com, subscribe to the free IFRS course, and find more IFRS stuff there. Bye, and thanks for watching.